persistent deflation. While falling prices might sound great for consumers, it's disastrous for an economy. To illustrate how much governments hate deflation, consider this. In the 1930s, the US government paid farmers to kill livestock and burn crops to artificially reduce supply and increase prices. In Japan, they use more conventional methods, including keeping interest rates near zero. Since about 1999, the Bank of Japan has maintained essentially zero interest rates, only raising them briefly in 2003 and 2008. Despite these efforts, they couldn't eliminate deflation and even experimented with negative interest rates, a bizarre concept. This situation created a unique opportunity for overseas investors who could borrow money in Japan at very low rates, essentially for free. This wasn't a big deal when US interest rates were also near zero. However, recently, the Federal Reserve has raised rates significantly, and this is where it gets interesting. Big-time investors discovered a simple strategy. Borrow in Japan, convert that money to US dollars, and invest in US treasuries, making a virtually guaranteed profit, a classic arbitrage play. To boost their profits, these investors realized they could amplify these gains by borrowing more than what they were putting down in Japan and using that extra loaned out money to buy big-name tech stocks like Nvidia in the US with additional leverage. Essentially, they were using double leverage. This strategy was working great, allowing investors to print money and circumvent the high rates in the US. However, there's a big warning with this trade. It only works if the yen, the Japanese currency, stays level or drops.